Let's talk about my stock portfolio yearly recap. Looking back at 2025, the growth of my portfolio tells two stories, one of financial resilience and one of strategic evolution. I started the year with $23,336.87 and it ended the year with $33,582.91. That represents a total increase of $10,246.04 or a 44% jump in total account value. Breaking down that $10,000 gain gives me a clear picture of how I got there. $6,900 came from disciplined contributions, $2,776 from capital gains, and $570 from dividends. On the surface, my dividend growth might look modest. I ended 2024 with $537 in dividends and finished 2025 with $570, a 6% increase. While that may seem slow, it was a deliberate result of two major life and strategic shifts. First, I had to navigate a period of unemployment from the summer of 2024 throughout the start of 2025, which naturally limited my ability to fuel the dividend engine. Second, and more importantly, I initiated a major portfolio recomposition. I made the conscious decision to sell out of some of my highest yielding safe companies to focus on long-term wealth increase. Before diving into specific holdings, I have to address the most significant change this year, sector allocation. This is related to the recomposition. Entering 2025, I identified a major issue in my performance. I was far too heavy and consumer defensive. While those stocks offered low volatility and a safe feeling, they were also the slowest growing part of my portfolio, causing me to lag behind the broader market. I spent the year reshaping the portfolio into a more aggressive, scalable machine by systematically reducing my consumer defensive exposure and rotating that capital into the technology sector. I pivoted from a passive stance to an offensive one. My goal was to build a portfolio that doesn't just sit there, but actually competes with the S&P 500 while providing a growing dividend and a lower but stable defensive stance. Here we have the before and after of my holdings, and don't worry, I will also write down on the screen the major changes so you don't get lost with the amount of letters and numbers. But if you look closely and recognize the tickers, you can identify the shift. I was explaining that the portfolio moved from passive to offensive. Let's start with the trimming. Starting the year, I had 23 holdings and I reduced it to 21 holdings. I completely sold Digital Realty Trust, Clorox, Kimberly-Clark, and Coca-Cola. I used those funds to add new holdings to the portfolio. As mentioned, I increased my technology sector and it goes as the following. Google from 3% to 12%. Automatic data processing from 1% to 6%. MasterCard remained high, but went from 8% to 7%. Visa, still a core holding, went from 7% to 5%. The reason why Visa and MasterCard didn't grow was because I didn't invest too much money in them and they stayed flat for the year. Microsoft and S&P Global were also added as meaningful positions. Now, the following companies got their exposure reduced in my portfolio, but it wasn't due to a sell or trim. It was more directed to my heavy increments to my tech stocks that naturally reduced the allocation of these slightly lower growth businesses. Realty Income 4% to 3%, Apple 4% to 3%, Procter & Gamble 2% to 1%, Waste Management 3% to 2%, Pepsi 3% to 2%, and Starbucks 8% to 4%. The rest of the companies like Texas Instrument, Hershey's, JP Morgan, and so on remain roughly the same allocation. Overall, by the end of 2025, my portfolio looks more intentional, more concentrated, and more growth oriented. I moved away from owning mainly safe dividend names and leaned into businesses that can compound capital and dividend for decades. Looking at my portfolio's performance versus the S&P 500, the biggest takeaway for me is consistency and downside protection. Early in the year when the S&P 500 struggled, my portfolio stayed positive every single month. From February through May, the market was down or flat, yet my portfolio continued to grow. That confirmed that my focus on high quality cash flow producing businesses did exactly what I intended, protect capital during volatility. As the market recovered mid-year, my portfolio kept pace. In June, July, and especially August, I participated fully in the upside and even outperformed the S&P 500 at times. This showed me that a dividend-focused strategy doesn't mean giving up growth. Towards the end of the year, the S&P 500 pulled ahead during a strong risk-on rally, while I underperformed slightly. My portfolio still delivers solid positive returns every month and ended the year with a good performance. In my monthly portfolio updates, I always cover the total return of all my holdings. For this case, I want to focus on my top 5 winners and top 5 laggards. When I look at my results, the pattern is very clear. My biggest winners came from high-quality businesses with strong moats, earning growth, and long runways, while my laggards were mostly defensive or brand-driven data-driven names facing valuation or growth headwinds. JP Morgan and Apple show what happens when I stay invested in dominant companies through full cycles. These are companies that have been in my portfolio for a while and they just keep expanding. Google is a company that I heavily bought this year after analyzing that they were about to become the leader in artificial intelligence. I was not wrong. Top 3 performer and largest holding by allocation. AbbVie, despite Humira patent expiration, the company delivered with their pipeline of products like Rinvoq and Skyrizi, performed pretty good this year. Waste management is a reminder that boring, essential businesses can quietly compound at impressive rates. Now, for the losers, Nike lost market share to competitors and iconic brands are just not performing in sales. Hershey's, cocoa prices skyrocket, eating profit margins of the business. This company is positioned to explode to the upside in the future though. Pepsi, sales lowering and consumer opting for healthier options. Automatic data processing, this company is down due to macroeconomic conditions, just like realty income, so nothing to worry about. My biggest gains came from letting great businesses run, not from chasing yield or rotating constantly. At the same time, my underperformance remind me that regularly question whether capital could be working harder elsewhere without abandoning quality. This reinforces my strategy. Own great companies, size positions intentionally, and let time do the heavy lifting. While we enter 2026, it's time to set goals to accomplish, but first let's reflect on the 2025 ones. 1. Continue increasing my stake in quality companies. 2. Get a job and continue investing. 3. Be more active and present. My goals were simple for 2025. I was enjoying my free time due to quitting my 9-to-5 job, so I had to stop contributions in order to save cash. The portfolio was growing in capital appreciation and dividends. Those dividends were reinvested in high quality companies so I can be in line with my number 1 goal. I did not know how long it would take me to find a job, but luckily I got hired in February, so it was a good start of the year and got the contributions rolling again. And the last but not least, wellness. What is the point of investing if I am not healthy? In 2025, I formed a run club with friends, completed my first 10K, and also became more active in the gym. Thanks to being active, I met a lot of cool people that today I consider friends, and overall just enjoying life more. So now, what do we have for 2026? I will continue high grading the portfolio. The portfolio brought a decent return, and that was due to the early changes I did at the start of the year. I want to replicate that by continuing to buy high quality businesses. 2. Contribute more. I already contribute $160 a week into my portfolio. If I can contribute more, that will accelerate the growth. I don't have an exact amount, but even if it's $5 extra a week, that will help. Number 3, continue growing as an investor. With that, I mean expanding my knowledge, making smarter decisions, and so on. And last but not least, I want my dividend portfolio to reach $45,000 in value and $700 in projected annual dividend. It's a challenge, but it's not impossible. So that will be it for this video. Let's make 2026 a great year, and I hope to see you guys in my future videos, sharing ideas and growing together. Thanks for watching, and I'll see you in the next one.